Hello everyone, and thanks for tuning in to the ESA Advisor webinar. My name is Paul Munn. I'm the Managing Partner at Par Equity, and I wanted to talk to you today about funding companies through their growth phase and hopefully on towards a successful exit. First, to give you a bit of a flavour of why Par Equity and I are qualified to talk to you about this, I just wanted to give you an overview of our activities. We've spent the last decade or so investing over £50 million in nearly 60 companies. Throughout that process, we've had 18 realisations from the portfolio. Not all good, but in aggregate, they've produced something over a 3 times money multiple and a 27% IRR. I think you'll agree that's very credible in today's market and puts us in the top tier of investors in the EIS space so far. What you'll notice is that those 60 or so investee companies have actually eaten up 329 transactions, which really brings me to the heart of the matter that we're talking about today, which is that you have to be prepared to follow on in these companies before you like to see money come back. Single hit investment is a very unusual scenario in early stage company investing, and you should expect and look and understand how the follow-on funding is going to reach those companies. We're interested in investing in innovative and disruptive businesses in the north of the UK. Those are principally companies that are in revenue, so we're not at the very earliest stage. And we would look hopefully to see monthly recurring revenues of somewhere between £20,000 and £200,000. We're quite keen to back experienced management teams. There's quite a lot of evidence to suggest that entrepreneurs who've been through this cycle more than once have a much higher probability of success. And you can see that in the maturity and efficiency with which they approach these opportunities. Ideally, we want a scalable business model with a global aspiration. That allows us to tap into much bigger markets and access a much broader range of potential buyers when we come to exit. We have over the years produced a series of successful exits and in fact have returned cash to investors every year since 2013. That again, I think is a market leading statistic and one that we're very proud of, and I continue to be hopeful that we'll have some distributions to investors in 2020, notwithstanding the rather unusual circumstances we find ourselves in. It won't come as any surprise to anyone that building a successful company doesn't happen overnight. Funding is rarely a one-step process for the company or the investor, and it is a journey, and that's a tired phrase, but it is a funding journey for the company, one that is likely to have some highs and lows. There will be bumps on the road along the way. And it's as well to understand that at the beginning of the investment process rather than be surprised at it halfway through. Each company will have its own profile, and some business models and industry sectors are more cash hungry than others. And in assessing your appetite for follow-on funding, and indeed appetite for risk, you should be looking to understand what type of company and what other precedents there have been for that type of company before you get involved. The ability of companies to access the right type of funding at the right price at the right time is quite key. And it's fair to say that equity funding in the form of EIS qualifying investment is unlikely to be the only source of funding that the company is going to use. Very early stage companies will often have access to grant funding and research-backed initiatives, but that is very helpful in an early stage and is non-dilutive for founders. Then moving through the gears to equity funding and perhaps on to later stage and more sophisticated equity funding from larger VCs and private equity houses. And debt shouldn't be ignored, which again is a non-dilutive form of funding. Not always available to early stage companies that don't have an asset-backed balance sheet, but increasingly the banks are becoming more sophisticated and able to work with these companies. The key question is at the end is to understand that journey before making the first investment and getting on that ladder. And it all boils down to effective due diligence on behalf of the fund manager, but also relies on you as advisors to ask those questions and be able to talk knowledgeably to your client. What are the key questions for you as advisors and to understand with your clients? Well, first of all, what is the investor prepared to do in terms of follow-on? There are pros and cons. Some investors do just want to deploy money on a once-off basis and create a large portfolio and see what comes out of that broadcasting of funding. I would suggest that it's probably more sophisticated to look at the opportunities that follow-on funding provide. As I've said, that is likely to be under a number of scenarios. We may have a very good run of success, continual up rounds, and working capital and equity capital required to fund that growth. And that can be a profitable and enjoyable journey to be on. It's also more realistic, though, to look at the opportunity for a down round where success hasn't been forthcoming, or there have been setbacks in the business plan. And those shouldn't be overlooked by investors. They are a good opportunity to top up investments and average down the overall cost of investment. And you are then, by definition, investing at a later stage in the company's development where you've got a more rounded picture of the quality of the management and the likelihood of securing investment and an exit from the company in the longer term. If you are prepared to provide future funding, as I say, that can talk into your risk management scenario. You can invest later stages with follow-on rounds where risk has been mitigated. But it's worth bearing in mind that given the EIS qualification period of 3 years, getting too close to an exit event can cause issues, and that needs to be factored into the decision. And overall, what is the investment time horizon, and does that fit with the company's plans? If investors are looking for a 3 to 5 year investment period and the company thinks it's going to take 10 years to get to scale, that sort of mismatch is one where there are unlikely to be good discussions and harmonious relations for you as the advisor sitting in the middle. It's worth bearing in mind. The investment manager primarily needs to make sure they understand what is the funding plan for the company. There should be a robust financial plan in place, and I would suggest that really needs to look at both the upside and downside scenarios to be stress tested. It's not the case that only bad news causes a requirement for cash. Follow-on funding can be a consequence of success, and that can be quite a stressful situation if the success is meteoric. External events such as COVID can also throw a spanner into the works. So-called black swan events do happen. And there have been noted instances in the last few months where EIS fund managers haven't been able to put in place the planned support for their portfolio companies. And you can imagine that's had quite significant impact on the underlying companies. And it's worth understanding what the company believes are the right funders for both its current and future financing needs. And does it have the relationships or the plans in place to put those funders together with the company to ensure that there is a consistent flow of money to support the business plan? For you as advisors to question the fund manager, I would suggest you need to look at the track record and have they funded companies to exit? What is the fund manager's ability to follow their clients' money and provide a ladder or elevator of success for their companies in the portfolio? Key to doing that is likely to be what other sources of funding they can access and what other co-investment partners and relationships that they have. Here at PAR, we have a variety of sources of funds. First and foremost and paramount is the PAR EIS fund, well-rated fund in the market, and our key source of funds, both for new and existing portfolio companies. It utilises and sits on top of the Power Investor Network, who are key to our process in terms of finding, diligencing and developing portfolio company opportunities. And then there are other sources of funds external to Power. In Scottish deals, the Scottish Investment Bank, where we can co-fund and match our investments into those local companies. But more broadly across the UK, we've been recently pledged £15 million of capital through the Regional Angel Programme. And that just provides additional firepower when we go looking at new deals and supporting the existing portfolio. So what are the key takeaways? I think for you as the investment advisor, it's to understand what is the funding appetite and risk appetite of the client, making sure that that has a match with the fund manager and the company's profile and funding needs. And I think following on from all I've been saying, assume that there will be further funds required and make sure that you understand where they are likely to come from or potentially can come from. I hope that's been helpful. And say I encourage you to think about not just the initial investment, but the future development of the company. And I'd be delighted to answer questions either now or at any time in the future. Please get in touch. Thanks again for your interest, and I look forward to speaking to you soon.